Hey, how you doing? My name is Austin from the Beyond the Books YouTube channel, and the title is clickbait. I'm sorry. All right, because the title itself says how to bounce back from losses. And the reason why you don't want to phrase it this way is it makes it sound like losses are something that's bad, they're not supposed to happen, and if they do happen, how do you get rid of them as fast as possible? Because they're scary. Which is just not true. Anybody that's been trading for a decent period of time, it is concrete in the foundation of your trading plan that losses and wins are going to happen. All right. And if a loss is trying to make you put your gun in your mouth or is making you take out the champagne bottle for a win, then you're probably gambling. So I hate to break it to you, but today we're going to talk about three things that will lead to 1, becoming comfortable with loss, and 2, maximizing your profit to save you time in the long haul to help your compounding portfolio build itself. All right. Because if you don't do these things, which I didn't do it in the beginning, you're wasting time and potential. So it's something that involves work. And I know you went to trading because you want to become a millionaire and you don't want to work anymore, but hey, you're here, so you might as well learn. So the first step is find a trading strategy. Now, it could be anything. I'm not going to judge. I have my personal beliefs on what I find to be the best trading strategy, but that's for me. All right. So 2 reasons why I'm not going to go ahead and try to impose my strategy on you is 1, you're my competition. So I'm not going to give you my secrets. All right. So whatever trading strategy that you have could be performing way better than mine in certain periods of the market and vice versa. So second reason, all right, we all are different. We have different mindsets and how fast we like to move things. Some people like smaller time frames, some people like bigger time frames, some people like certain indicators. So to say which one is better is arrogant of me. So moving on, I'm going to ask you to do something that most YouTubers will only say because they are promising you a 90% win rate and you'll never lose money. So you start throwing millions of dollars at it and you lose everything. Use the test net, okay? Or if you do need the psychological stress of using real money, use 5% of the total portfolio that you're already going to allocate to trading, okay? And then beyond that step, you really want to add, all right, the creme de la creme. It is extra work, but try to find 3 trading strategies. And the reason for this we'll cover later. But once you have trading strategy and you have a testnet account set up or some sort of paper trading or real money, it's up to you. All right. I need to go on Google and type in trading log, or you can use Google Sheets or Excel. Now, trading logs and Excel are both going to cost you probably around $7 a month, depending on which ones you choose. All right. That's capitalism, baby. I think you can't mess around with it. All right. Everything's got a price. So now that you have a trading log, time to get to work. Start trading. And the 3 things that you want to track, more importantly than anything else, is going to be, did you win? All right. When you won, how much did you walk away with in terms of how much you were willing to lose? So risk to reward ratio, 1 to 4, 1 to 5, whatever it might be. Okay. So once you do that, the last thing would be, was it a long or was it a short? Which sounds very weird and you might not get why I want you to track that. So once you have all these things tracked for at least probably 3 months, I would say. Okay. Now 3 months is not technically the best optimal number for this, but it's a decent period of time to get started. All right. 3 months could be 3 months of a bear market. It could be 3 months of a bull market, 3 months of a sideways market. And each market probably will perform differently than the other with that particular trading strategy. So you want to go ahead and track all the time. But after 3 months, you should have a baseline whether or not that trading strategy is profitable. And the way that you find this out is simple, okay? By using the win percentage and the risk to reward ratio, you can find out if it's profitable. For example, all right, a 1 to 4 R&R, you need around a 25% win chance in order to break even, meaning your account is pretty much stagnant, okay? If you get a 1 to 5 or a 1 to 6 or a 1 to 7, you're making money now. All right. So find that out. And here's the kicker. You want a buffer of profit. Okay, you don't want to try to make as much money as possible if that is not reasonable. But if you can find a trading strategy that has a buffer period between breaking even and what the average profit would be, okay, and that's important. When you're tracking those statistics, you need to find the average R&R between all of the wins, okay, not just the upper echelon or lower tiers of profit. You need to find out what you're consistently walking away with on average, all right? So if I have a 25% win rate and I have a 1 to 7 R&R, all right, even if the market's performing not quite as expected, I still have that buffer period of 6 and 5 before we get to the break even. So that way we don't have any moments where we're really going deep down into the negatives. That's perfect. If not, that's your call. So once you find out that a trading strategy is profitable, that's when you can allocate more money to it. I always screw up my words on these. So, and you can get yourself off of little baby testnet. All right. And I wouldn't say throw your entire stack, because like we talked about, you might only be in one type of market. And once that tide shifts, you might have a little bit too much risk allocated to it. So you don't want to get yourself in a pickle. All right. Have the statistics. Not only does that help you not conceptually understand that losses are not a bad thing, but emotionally understand, because you've gone through it yourself using a small amount of risk, so it really didn't impact you as much. So when you start using the big boy numbers, you're doing good. Now, by utilizing this information, we can maximize profit. This is the kicker, okay? Losses show you a picture that might have not been possible if you didn't track this information, all right? I didn't do it in the beginning myself, so I understand. But by doing this, you will become a better trader. By using something called Kelly criterion, we can punch in those numbers. Kelly criterion works best off of hard variables, such as like a blackjack game or anything that involves chance like that. But the market itself is not a hard variable game. So there's something in Kelly criterion called full Kelly. Basically, it's the optimum number that allows you to make as much money as possible, but have the best amount of safety possible. All right, so over here, you're being a little baby bitch. Over here, you're being stupid. All right, you want to find that balance in between. So in a perfect world, if your trading strategy consistently stayed the same exact percentage win rate and the same exact amount of money won, then yes, you could use full Kelly. But we don't live in that world. All right, our psychology, although has repeating patterns, which is what we take advantage of in trading, we don't always stick to it. We do things that are unexpected. So for those hiccups, we don't want to use full Kelly. I would say probably use somewhere around 30 to 40% of full Kelly. A good example is, let's say you have a trading strategy where it's profitable and you're using 1% risk because every YouTuber tells you to do that. But you punch these numbers into Kelly criterion because you've been comfortably tracking your win rate and all that good jazz. And Kelly criterion says you could be using 6%, which sounds like a lot of money to me. Because of that, you might be inclined to go use the 6%. But more than likely, I would say use somewhere around 2%. Okay? Now, the reason why that doesn't sound as awesome is because it's just 1 percentage point. But let me put it into perspective like this. By using that trading strategy, to get from $1,000 to $100,000, it takes you 10 years. Okay? But if you do the work and you find out that you can increase your risk to 2%, instead of 10 years, it takes you 5. So by the time the other person gets to the 10-year mark and they make their 100 grand and they feel happy, you could have significantly more than that. Now, it gets better. You want to specialize, all right, from asset to asset, from market to market, and you can really start to put some numbers on the board that most people don't find possible. All right, if you find out that a certain trading strategy is glorious during a bull market, and one that's good in a bear market, and one that's good in a sideways market, right, because then you can start to increase your win percentage across the board and really take advantage of everything. And with the longs and shorts I had you tracking, if you find out that that trading strategy prefers shorts over longs, say shorts have a 70% chance to win, whereas longs only have a 20% chance to win, well, just stop trading the longs. All right, I know it sounds like you're missing out on opportunities, but you're really not. Look at the statistics that you've been tracking. So from there, you're actually increasing your win ratio by quite a lot, which means, Kelly Criterion, you can increase your risk. Now always keep it safe, but you can see how we can start to get deeper and deeper into this, where if we find out we have a trading strategy that prefers shorts over longs and longs over shorts, we have two separate trading strategies that we combine together, and now we're really killing it. These are the very basics, and we'll definitely cover stuff like this in the future. But for right now, I want you to think about it. Go sign up for a trade log, or put in the time and effort to create your own, because it is truly, truly important to the entire process of trading. Thank you for watching. My name is Austin, and thank you for watching Beyond the Wicks, where we talk about things beyond the Wicks, because there's so much more than just a chart. I rehearsed that a lot. I don't know if it's going to stick, but like always, if you really like the video, like it, subscribe for more, and if you have any feedback whatsoever about any topics that you would like to see covered, or the quality of the video, anything, please let us know in the comments. I appreciate you very much, and I'll see you in the next one. Bye-bye.
This is terribly important to understand Buddhism, because the better you get, the more you go up to the Deva world. The worse you get, the more you go down to the Naraka world. But everything that goes up has to come down. So you can't improve yourself indefinitely. If you improve yourself beyond a certain limit, you simply start to get worse. Like when you make a knife too sharp, it begins to wear away. So the Buddhahood, or liberation, enlightenment, is on no place on the wheel, unless it might be the center. By ascending, by becoming better, you tie yourself to the wheel by gold chains. By retrogressing and becoming worse, you tie yourself to the wheel with iron chains. But the Buddha is one who gets rid of the chains altogether.